In your estate plan, you want to leave something for the kids. So in this episode, Terry Wheeler reviews ways to maximize an IRA that is earmarked to go to the next generation. I'm Patrice Sikora. And Terry, let's start with an explanation of this idea, and then how often do clients choose to do this?
Well, hi, Patrice. Great talking to you again. This is an area that we see a lot. So it just depends upon each client. Of course, most of us want to take care of our kids the best we can. But when we talk about large IRAs, so we have a lot of physicians, Kaiser in particular, and we typically see $1 to $5 million IRAs. And these are clients that also are blessed with a very nice pension. So they have a very good retirement. So a very common situation is we are managing this retirement account as a safety net for the clients, and maybe even so that they can live that ideal retirement, but it's growing over time. So for these clients, a lot of times we're really focusing this on how do we maximize it for the next generation. And that's really what we're going to talk about today is how do we maximize it given the world of taxes and what's called a RMD or required minimum distribution, which forces them to take it out over time. So we see it very commonly in our practice, but it is typically for larger IRAs. Now, for the listeners, they have an idea of who are these strategies going to be for. RMDs affect everybody. So that's going to be for everybody. But some of the larger tax strategies we'll hit on, it comes down to a combination of how big is your retirement account and how many kids do you have. So for instance, if you have $1 million retirement account and 5 kids like me, that's $200,000 going to each. You may not need this planning. If you have a $5 million retirement account and 5 kids like me, you need this type of planning for sure if it's growing. And if you have 1 child and a $500,000 account, this might be good for you also. So each situation is different, but as you'll see, there's some very powerful ways to leave your retirement account to the kids and grow the wealth by doing great tax planning. So I'm going to have my tax planning and legal hat on today because we're going to talk a lot about strategies that involve the tax law.
Do clients often use this once you've explained it to them?
Yes. I would say for our clients that have the larger IRAs, this is becoming a staple in their plan because we create a short, an intermediate, and a long-term, which includes multi-generational tax plan for every client. So when you do that, this is part of that long-term or multi-generational, that it's not uncommon that we can project 7 figures of additional wealth for their kids by doing the planning versus just giving it to them outright. So it is one of the most powerful strategies. And that's the third strategy we're going to talk about today. We want to hit on 2 more routine strategies, not quite routine for one of them. Roth conversions we'll hit on. That's routine, I would say. But that's just the tip of the iceberg for planning.
All right. Well, let's jump into these key strategies then. Talk to me about these.
Okay. So we have 3 that we're going to cover today. So one is going to be really talking about what I call an RMD or required minimum distribution rescue strategy. Then we'll hit on Roth conversions. Then we're going to hit on a charitable strategy. So the first one is RMD rescue strategies. So first of all, just to remind everybody, or if you're not familiar with RMDs, the government says you have to take a required minimum distribution at 73. And then depending on when you were born, if you're very young, it's going to actually be 75. But let's use 73 for today's example. So at 73, they start forcing you to take money out of your retirement account, IRAs, 401ks, 403bs, whether you want to or not. If you don't, they don't take it out. They charge you a big penalty. So you have to take it out. So an RMD, to give you an example, I pulled the numbers at age 73. You have to take out roughly 3.8%. And it goes up every year you get older. So by the time you reach age 85, you have to take out 6.25% that year. And by the time you reach 100, you have to take out 15.6% that year.
15?
If you're 100. So if you can be a centennial, they want you to empty your account and pay your taxes.
Really?
Yeah. So that's the goal. So if you don't need this money, how do we rescue this plan? And an RMD rescue plan is a series of strategies. So we'll highlight one of the key ones that we take the RMD, we combine it with investments in the IRA in a way in which we can convert your IRA to tax-free money for the kids. And if you're a larger estate, taxable estate, we do it outside of your taxable estate. So not only can we convert that taxable IRA to tax-free money for the kids, but we can keep it out of your taxable estate so we don't have to pay a 40% estate tax also.
All right. Are you talking Roth here? Roth conversion?
No. This is not a Roth strategy.
Okay.
So let's say you've got a client that has $1 million IRA. And I'm going to give you approximate numbers because everything's based on age and health. So you can't really talk to generalities. You got to run the analysis for each client. But let's say you have a 73-year-old client and they are trying to take their $1 million Roth or their $1 million IRA, and they have RMDs. So they're being forced to take out money, and they want to convert that into tax-free money for the kids. If they have a larger estate, they want to avoid the estate taxes. So what we do is we take the RMD. First of all, we create an investment within the IRA that will meet these RMD distributions, even if they live till they're 110 years old. So an income stream they cannot outlive. You take that income stream, the RMD, or more, so you can go more than the RMD, you just can't go less. And you put it into typically in this, you're going to use a type of insurance contract that we call second to die. So you can use first to die or second to die, depending on if you're a couple, but you want the insurance costs down. We will routinely bring in a lot of non-commissionable term insurance, meaning bring down that cost of insurance to maximize the value to the family, not maximize the commission for the advisor. So the key is build it right. Don't build it for your paycheck as an advisor. And when you do that, you can convert this money. We ran a 73-year-old example, and based on a modest rate of return, we could take $1 million IRA, give about 1.6 million tax-free to the kids using only a portion of that IRA. So the earlier you start, the better. If you start this plan at say 63 instead of 73, we can create a phenomenal long-term plan. And if you need the money, you can spend it. So you're not locked in where you can't get to your money. So it can be extremely powerful for your kids. So we call this one of the RMD rescue strategies. And there's more than one, but this is one of the more powerful ways to convert money to tax-free. But it's for somebody who's really doing it for the next generation.
And you say each case really has to be looked at individually, age and health and finances?
Absolutely. So let's say we have a client that is, they're in the same situation, but they don't have their health. They can't do life insurance. It's too expensive, so it makes no sense. In that case, we'll have to do a little different type of an RMD strategy. And in this case, there's a variety of things we can do. But if it truly is for the next generation, we can try to start using those distributions to create a Roth-like strategy that will be transferred over to their kids. So we'll create an investment that will grow tax-free, can be accessed tax-free, and it won't be taxed until the kids pass away, meaning not our clients, but their kids. So we can defer, grow money tax-free over their kids' lifetime. And there's several ways we can do that with young people. We can even use some leverage, which can really accelerate the returns. That strategy, it kind of dovetails very well because we teach the kids of our clients, we teach them how to do wealth building. So most of our clients are about wealth optimization, protecting the downside. We want to control volatility so in retirement, they can have less stress. So we call it putting them on a path to a stress-free retirement, which can't eliminate stress, but we can definitely reduce stress. For the kids, dry powder is how you build wealth. Meaning we talk a lot, and we'll do an episode about this. We talk a lot about how wealth is built in America, and it's not built by dollar cost averaging into the stock market. Yes, it's a good vehicle. It's great for savings, but most wealth is built by businesses and in real estate. And the key is buy right. So if you're talking about businesses, we're not talking about buying all the stocks. That's how you reduce risk. But if you just buy a company, like you bought Apple and that's where all your wealth was, that's owning a business. And that's where your wealth can really grow tremendously. Or if you start a business with real estate, you bought real estate in 2009, 10, 11 after the market crash. You did phenomenal. I don't think we made less than 400 or 500% on every single investment. We made several after that crash. You can only do that if you have dry powder. So we combine the RMD rescue strategy with educating the kids, and that can really increase not only wealth, but the financial well-being of your kids. But you got to train them as part of this strategy also.
That's interesting. Very interesting. Training the kids and teaching them how, not just what, but how.
Yeah, I
You
mean,
mean,
with estate planning, we build a lot of wealth and we want to transfer that to the kids, but we also work hard with our clients to transfer some of their wisdom to their clients or to their kids.
mm-hmm.
And that wisdom, when done right, can be as valuable as the wealth you leave them. And it can help make sure they don't become that statistic where they spend the inheritance in less than 3 years. And that's what we're always working against. We don't want to be that terrible statistic. And it's a real stat. So we want to fight against that.
All right, you did mention Roth, and I mentioned Roth. Talk to me
Yeah.
some more about the conversion idea.
Yeah. So we're going to talk about Roth conversion today in the context of how does a Roth conversion fit in to maximizing wealth for your kids? So there's a lot of benefits for the clients, and that's an episode in and of itself. Should we convert? What are the income tax advantages? How can that maximize your retirement? But for this episode, we're talking about how does it affect the kids? Now, where this is most beneficial is when we have taxable estates. So right now, you got to have 26 million for a couple before you're taxable, but this is scheduled to go down to 5 million indexed up for inflation here in 2 years. So for a single individual, if you've got over a $5 million estate, which in California, we see those regularly, you've got a 40% estate tax.
Mm.
So if you take $1 million IRA, and let's say you're subject to that estate tax, so they're going to charge you roughly $400,000 in estate taxes because of that million. If you've got, let's say a $10 million estate. And when you pull that million out, you're going to lose another 40% or so to taxes. So you don't own hardly any of that IRA. It's going to the IRS. That is who you've been saving for, not your kids. So when we do a Roth conversion in that scenario, we convert the million, we pay the taxes in after-tax dollars. So that reduces your estate by 400,000 if we're paying all those taxes. So that by paying the taxes, you're eliminating about 160,000 of estate taxes because you paid the tax ahead of time. So when you die, it's not in your estate. And now you have a Roth that is growing income tax free for the rest of your life. And it goes to the kids. They can continue deferring it income tax free for up to 10 years. So when you do that, ultimately, again, it depends on age of our clients, meaning how long are they going to live, which goes into the life expectancy analysis we do. So you got to combine how long are they going to live and make sure that the kids will actually defer for 10 years, which you can build that in and even require it in the estate plan. And then you can maximize the value. So Roth conversions can be a very powerful basic tool whenever you have a taxable estate. For a non-taxable estate. What's that?
It's a win-win.
It really is. You hate to say no-brainer, but if you're a taxable estate and you have a big IRA, it's a pretty darn close to a no-brainer. Now, there are more powerful things we can do in addition, but this is something that we would want to do. The other thing, if let's say you're not a taxable estate, we got to do all the traditional analysis of, is this good for you? Now, if you're not going to use the money ever, then that analysis switches to, if we do the conversion, is it good when it goes to the kids? So we have to look at their income tax bracket. How powerful will the Roth be by being able to defer another 10 years? And we can pick up some nice additional gains just by reducing taxes that way also. So the Roth conversion analysis, definitely we need to look at how it affects our clients and their retirement and the retirement life they want to live and reducing their lifetime tax bill. But then we take the next step and say, can we also reduce the lifetime tax bill for all kinds of taxes, whether it's income tax or estate tax or capital gains tax for the kids?
And I think that's a step that many people don't even think about. It's all, how am I going to benefit from this? It's not, oh, this could really leave my kids with a big tax bill.
Yeah, and it depends on your goals. So I had two clients yesterday, both large portfolios and newer clients. And one, their goal, spend their last dollar before they die. Okay. The other, they're clearly managing their portfolio for the kids because they have strong pensions. They're living the life they want to live just on the pensions. This money is going to the kids. And they're in a position where, assuming we have good growth, they could very well be a taxable estate also. So we'll be doing not one of the strategies we're talking about today, but we will be doing a combination of 2 or 3 of them. So you don't have to choose a strategy. It's how do they work in conjunction. So let me give you an example. The RMD strategy. You're forced to take out 3.6% at 73. Well, if we are able to grow the portfolio at 7, your portfolio is still growing. You're going to leave a lot to the kids even after the RMDs. So what are we going to do then? And the next strategy, which is our charitable strategy, can dovetail maybe partial Roth conversions. Maybe we're doing some of that, and maybe we're doing some RMD rescue strategies. So they could be doing all 3, and the combination can give them the balance of how much money they want to spend versus how they want to optimize after tax inheritance for the kids.
Talk more about that charitable option.
Yeah, so that's our third option, and it's one of the more powerful. It's very common. Meaning in our practice, it's very common. And what you're basically doing there is you're using the charitable tax status to defer your income tax bill for at least 1 generation, but we actually teach them how to do it for 3, 4, 5 generations. So let's just take a very simple example. So say we have $1 million in our IRA going to 1 child. And let's say that child is at a 40% marginal combined state and federal tax bracket. So very common here in California. They're going to lose 40% of that IRA. The government makes them take all that money out within 10 years.
Right.
So the first 10 years, we can do the same thing as the charitable strategy, spread it out over 10 years. And there's really, to me, there's not much of a benefit. Now you could argue either way, but 10 years is kind of a gimme because it's in the tax code. But if you're like me, my wife and I started having kids later in life, and our kids have a 40-year life expectancy beyond ours. 40 years, because we were roughly 40 when we were having our last kids. Our triplets we were 40. So we were older parents, and that's very common in our area. So the key here is that's another 30 years. So if you can take that $400,000 tax bill that $1 million distribution is going to cause, and you can invest it, and let's just say the first 10 is a wash. So we got 30 years. If we can do a deferral strategy, how much additional wealth can we make off of 400,000 in 30 years? And that all comes down to how you're managing your portfolio. So all portfolios are different, but let's just make it easy on ourselves. And let's say you were able to somehow achieve a 7.2% rate of return, which means the money will double every 10 years. So your $400,000 deferred money will grow to 800, then 1.6, then $3.2 million before your kids pass away. Now, in this strategy, we're spending the income that we set up over our kids' lifetime. So what do I mean by that? If we set this up as a 7% charitable strategy for $1 million, your kids are getting $70,000 a year for life. Now, if you're able to earn 7 in the portfolio, the $1 million stays steady and you're getting $70,000 a year for life. So over 40 years, if they live 40 years longer than you, that's $2.8 million that they get to take out.
Mm-hmm.
If they pay their taxes, they do everything perfectly, then the break-even point is going to be somewhere around 18 years in today's tax environment. And what I mean by that is if they save the money and they invest it, they pay their taxes and they do everything perfectly, which we know statistically the kids spend the money and it's gone after the 10 years. But if they were to do it perfectly, we will have about 22 years in my 40-year example, 22 years of $70,000 a year payments. That's all profit. Whoa. That's extra wealth. So when you're talking about 22 years, that's over $1.5 million. So this can create 7-figure wealth. But we don't stop there. We then structure it to where we have to distribute the money after your kids pass to a charitable entity. We set it up in a way in which your kids can run another charitable entity, your grandkids, and we can defer those taxes and have a continue giving benefit for multiple generations. Maybe it's enough to send all the grandkids and great-grandkids and even the great-great-grandkids through college. So tax planning is powerful. And there's a phenomenal side benefit to this strategy. You're creating money for the charities that you want to support. So we call it social capital. And a lot of people don't realize you can either give the money to the IRS. So if you think they're good stewards of your money, by all means, just pay your taxes and be done with it. Or if you think you could find a charity that's going to do better with your money than the IRS, it's your choice. Each of us have that choice with our IRAs. Do we pay the government taxes or do we send some to charities of our choice instead? So we do this to maximize wealth for the kids, but a phenomenal side benefit is our clients become philanthropists because something does go to the charity. So it's a fun strategy to do, and it gets people thinking about what they really care about and what causes do they want to support. So it's one of my favorite strategies.
Just out of curiosity, is it difficult for clients to choose a charity?
Yeah. Well,
because I'm sure so many people want to give to so many things.
Well, here's the reality of the strategy. The charities don't actually benefit until your kids die.
Okay, they can wait.
But that could be 40, 50 years, 60 years from now, because I might live another 20, 30, 40 years, and then my kids live another 40 years. So let's say we want to support cancer. We have cancer in our family. We want to support the Cancer Society. Well, cancer might be cured in 50, 60, 70 years. So we need to create these so that the charity and the charitable causes are broad and flexible. And very often we're letting the kids and grandkids choose the charities based on what does the world look like at that point. So flexibility is key here, but the clients can choose their initial charities, but oftentimes that will be able to change over time.
Very interesting. Terry, lots of stuff here. Is there anything you haven't covered that you want to make sure you do?
Yeah, so with retirement accounts, it fits how we do this and why and how it fits into your portfolio. Not only are we looking at the retirement accounts, but we have to look at the entire picture, meaning how much after-tax money do we have? How strong are our pensions, our Social Security, any private pension strategies that have been built into your plan? All of that is designed to first and foremost typically make sure that our clients that are retiring, that have worked so hard, that they are living the retirement life they want. But if we do this well, they often realize there's going to be a lot left over. And that's when somebody who wasn't even planning on maximizing what's going to the kids, but they'd rather go to the kids versus the IRS, a lot of people this strategy applies to if they do better planning at the base level. So all these podcasts I think are great. The challenge is, how do you take all these pieces of the puzzle and fit them together? And when you do that, bring in the financial world, portfolio management, insurance world, tax world, estate planning world. This is what a certified financial planner learns to do, but a lot of them are not licensed to do all these things. The key is to be able to do all this and fit it together. When you do this well, that's what creates such powerful plans for our clients. So I enjoy being the puzzle maker.
All right.
And then the heavy lifting our team does because they get to do all the paperwork to implement. But the design stuff is just fun. So we've been doing this 35 years, and it's fun to put this puzzle together for clients and to really bring real value to each family.
Well, if someone has all the pieces to their puzzle, but they don't know how to put it together, how can they reach you?
So the puzzle keeps changing too, because the IRS keeps changing the rules. But so they can reach us, of course, through the website, which is www.wearaadvisors.com. And of course, you can just reach out to us directly at 916-325-0130. And we'll put links. You can find us in YouTube, Facebook. We have a team that tries to post things, so you should be able to find me in different areas now. And we'd love to talk to you and see if we can help you. So even advisors out there, if you're an advisor listening, you want to learn how to do this. We can only help so many families, and we've started training advisors. Here's what you should be doing for your clients to maximize what's good for them, because advisors want to do what's best for their clients. Unfortunately, many of them, like me, when I was an advisor in my 20s, you only know what you know. So most of these advisors are good people trying to do good by their clients. They just don't have enough experience in all these different complicated areas to bring the level of value that clients, I can tell you, they really love receiving. It reduces their stress, increases their wealth. It's a great experience as a client to go through true comprehensive integrated planning, but it's a new experience because most people simply aren't getting that.
Terry, lots of great stuff. Thanks so much. And listeners,
You're welcome.
follow this podcast. That'll make sure you know when a new show is ready for you, and of course, share it with others. Thanks for being with us.
I'm much better at strategies than I am at marketing. I'm supposed to tell everybody to follow each time, so we would appreciate that. And we will do our best to make sure you continue to get value. If you can be a dedicated listener, it's going to pay off for you. So thank you for listening.
All right, thanks for being with us.
All right.
Thank you for listening to We Money Talk with Terry Wheeler. Be sure to click the follow button to be notified as new episodes become available. Information presented is for educational purposes only. No listener should assume that any discussions or information presented serves as the receipt of or substitute for personalized advice from We Alliance Wealth Advisors, Inc. or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. We Alliance Wealth Advisors, Inc. is not a law firm or accounting firm, and no portion of this podcast should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not appropriate for every individual. Listeners are encouraged to seek advice from qualified tax, legal, or investment advisors to determine whether any information presented may be suitable for their specific situation.